One summary I have given. This will help you to revise. So let us see the summary. Normally, this summary is from examination point of view. This summary is from examination point of view. So investment in equity shares. Can I say investment in equity shares can be investment in subsidiaries, joint venture, associate, then scoped out from this chapter. Refer Ind AS 27. But if it is investment in other entity, it can be held for the purpose of trading. Then FBTPL. And if the question is specifically mentioned, then we can apply FBTOCI without recycling. Means if question is specifically mentioned, then only apply. Otherwise, apply what? FBTPL for investment in equity shares. It cannot be AC. It cannot be AC. I hope you have understood this. Then investment in debentures and other securities. The investment debenture, if it is held for the purpose of trading, then what? FBTPL. If not held for the purpose of trading, then find out held to collect contractual cash flow till maturity. If yes, then amortize cost by applying EIR. And if it is held to collect contractual cash flow and sale whenever required, then FBTOCI with recycling. In both cases, can I say interest income will be calculated by applying EIR? In both cases. Chalega? Yes, sir. Then concessional loan given or security deposit. Concessional loan given. Concessional loan given to any party. Correct? Or security deposit. Just try to deposit normally is at interest free. Deposit is always interest free, but that is contract. But can I say whenever you have given any deposit, so it is always at off market terms. So it will be recognized as fair value only. And the difference we need to understand what is that. Are you getting? I'll just say. So can I say whenever concessional loan given or it is a security deposit, a security deposit is always at off market terms. Are bolna rahi? Because it is given without any interest. Because it is given without any interest. It is always at off market terms. So as per our concept, we'll say transaction price paid minus what? Fair value loan. Fair value of loan will be present value of contractual cash inflow discounted at market rate of interest. The difference will be what? Either expense or prepaid expense. For example, just try to understand. For example, you have given deposit for a lease transaction. This question have been given in ICAI study material. You have given deposit. So you are lessor or lessee? Lessor will receive or lessee will receive? Deposit will be received by which party? Who will pay deposit? Lessee? Lessee. So if I have given deposit, so I am lessee. Correct? Now deposit given. Can I say this will be refundable at the end of the lease term? But without any interest? It will be off market terms. Now suppose deposit is 1 crore. Can a present value may be only 40 lakh? The difference coming 60 lakh. So this 60 lakh is nothing but, can I say, lease payment. You are paid for taking the asset on lease. Yes or no? This is nothing but will be considered as a lease payment. And can I say any initial lease payment will be added to ROU asset? If you remember Ind AS 116, means this will be accounted, just write down, this will be accounted as Ind AS 116 if it is a for a lease transaction. One question has been given in ICAI study matter. Can you refer that question by your own? Or I will take right now. Have you understood? One question has been given, that question I have not taken. Are you able to understand what I am saying? Correct? But skin is simple only. I should take question. I will take at the end. But I have not taken that question in my question booklet. I need to find out. But have you understood this point? 60 lakh. For that you need to understand Ind AS 116. But can I say it will be lease payment paid initially only? Now what Ind AS 116 says that, have you understood this is lease payment or not? Whatever you are paying extra, that extra you are paying for lease transaction, and whatever you are paying for lease transaction will be lease payment, and any amount of initial lease payment paid will be added to ROU asset. Are you getting? Means we'll pass one journal entry. Journal entry what? If you say journal entry what? Loan receivable account debit, ROU asset account debit to bank. And on this, Ind AS 116 will be applied for depreciation, etc. Understood? One question has been given. If you want to do it by your own. Today you will do. If you are not able to understand, I will do it. Chalega? But that is a good question. Chalega? Yes, sir. Then, next point, concessional loan to subsidiary company. One question I have given right now. Concessional loan to subsidiary company. So in that case, 1 second, transaction price less fair value loan. The difference will be considered as what? Investment in equity instrument. So what journal entry you will do in the books of parent company? Loan receivable account debit, investment account debit to bank. What journal entry you will do in the books of subsidiary company? Okay, it will be bank account debit to loan payable to equity instrument. This is nothing but compound instrument. Can you see it can be reverse also? Concessional loan to parent company. So concessional loan to parent company, same thing, transaction price paid less fair value of loan. The difference will be what? The difference will be what? Deemed dividend. Because in this case, subsidiary company is paying to what parent company? So subsidiary company will distribute dividend. It will become deemed dividend income for parent company. So what journal entry will do in the books of parent company? Bank account debit to loan payable to dividend income. What journal entry in the books of subsidiary company? Loan receivable account debit to deemed loan receivable account debit, deemed distribution account debit to bank, and this deemed distribution will debited to retained earning. This is also important from examination point of view. Have you understood? Then demand deposit. Demand deposit means, can I say, any deposit which can be demanded, we need to pay it. Demand deposit means any deposit received or paid. So what they say, demand deposit is nothing but current item. So this will be recognized at undiscounted amount. Because it is payable or receivable on demand now. It is payable or receivable on demand, so it is current item. So there is no need to do any discounting. Are you able to understand? For example, say, can I say current account, bank balance, current account. Current account is nothing but demand deposit. So will you do discounting for that? No, not possible. Correct? So what they are saying, fair value of demand deposit will be the amount payable on demand in the books of party making the deposit, or as well as in the books of entity accepting the deposit. Means it is nothing but will be recognized at undiscounted amount. Undiscounted amount. And there is no need to apply amortized cost method, means will not apply any amortized cost method on that. Got it? Understood? This is also important. One question has been given on this. There was one deposit given which is repayable on demand. So what will be journal entry when you have paid it? Deposit account debit to bank, repayment bank account debit deposit without any discounting. If there is no discounting, the question of interest income will not arise now. So will not recognize any interest income or expense as the case may be. Got it? Then trade receivable. Can you trade receivable means Ind AS 115? Trade receivable means Ind AS 115. Means trade receivable is initially recognized as per the requirement of Ind AS 115. Because when I am saying receivable, trade receivable means revenue, revenue means revenue recognition as per Ind AS 115. So initial recognition is done as per Ind AS 115, but subsequent recognition may be done as per Ind AS 109 if it involves some significant financing component. So this you will automatically understand when we will do Ind AS 115. So I'll just when I will take Ind AS 115, I'll just give a reference of this point. There are some points which are linked with other Ind AS. We can understood when we have done that Ind AS. Correct? Yes, sir. This point is not important. No question is given in ICAI study matter. Leave it. Any doubt? Any doubt? Understood? Then come to above. page number 223. There is some modification in cash flow. Suppose initially there was some contractual cash inflow which was modified subsequently. Quite possible. Quite possible. Understood. Means initially there was some contractual cash inflow which was modified subsequently. Whenever it is modified, what Ind AS 109 says that carrying amount will be restated. Carrying amount will be restated. Correct. At present value of remaining contractual cash flow as per modified terms. Discounted at original EIR. Understood? Means, let me take one question. Let me take one example. Suppose initially there was 5-year contractual cash inflow was 10,000, 10,000, 10,000, 10,000, 1 lakh 10,000. So initially we have done present value of this. This become fair value. Then we calculated amortized cost. Then we calculated amortized cost. But what happened? At this point of time there was some modification. Now they said we'll pay 20 and 100 yahan par. Modified. Modified. Change in terms and conditions. So what Ind AS 109 says that now you'll find out the present value of these as on this date by applying original EIR. Means this fair value was calculated at 10%. So this will be also what, 10%. Then calculate restated amount. The difference of these will be either adjusted in expense or prepaid expense as the case may be. Understood? Means can I say when you have initially recognized there was some, either the difference was transferred to expense or it was an asset prepaid expense. The difference will be adjusted either to expense or prepaid expense as the case may be. Have you understood this point? One question have been given in ICAI study material. That question is already asked in exam. But have you understood the concept? Concept you understood? One second. This concept, what they are saying. Initially my cash flow was 10, 10, 10, 10, 110. This was contractual cash inflow. And suppose it is at off market terms. You will calculate fair value of loan by using market rate of interest. So fair value you have calculated at this point of time. Then you have applied amortized cost and this is the carrying amount as on this date. But on this date modification happened. Now they said you need to pay 20 as on this date and 100 as on this date as per mutual understanding. Quite possible. This is a modification in cash flow. Whenever there is a modification in cash inflow, what Ind AS says, then you need to find out, you need to restate the carrying amount. At present value of remaining modified cash flow, discounted at original EIR. So initially what was my EIR? The discounting will be done at 10%. Now this amount may be different than this amount. So suppose this amount is what? 5 lakh. This become 4 lakh suppose. You reduce what? Your financial asset. This will be adjusted in expense or prepaid expense as the case may be. Means if initially the difference was transferred to expense, so this also difference will be transferred to expense. If initially the difference was adjusted in asset, so this will be also adjusted in the same asset. Now understood? That is only given. If there is a change in the timing or amount of estimated future cash flow, the carrying amount of financial asset will be recomputed at present value of remaining contractual cash inflow discounted by using original EIR. Any difference due to such prepayment will be prepayment or whatever kind of modification. Due to such modification will be adjusted in PL or prepayment account as the case may be. Understood? One question has been given ICAI study material. I am assuming that you can do it by your own. But that question is already asked in exam. Correct. But can I say now if you know the concept, you can attempt it. If you know the concept now, that question you can attempt it. Because entire thing now depends upon what? Concept. Discounting to you are expert. Calculation you have calculator. Only what is required? Concept is required. Correct. But if you don't know concept, then you can't use calculator. Are you getting what I am saying? Yes, sir. This also done. With this, we have done discussion of what? Financial asset. Financial asset discussion done. Understood? Once again, I will repeat, the doubt came about off-market terms. Whenever there is an off-market terms, it means we need to find out fair value. Fair value means what? Present value of contractual cash inflow discounted at market rate of interest. Understood? So whenever you are calculating fair value you are calculating by discounting at market rate of interest. Now the question is that you recognize interest income by taking which rate of interest? So always EIR. But I said if there is transaction cost, so initial recognition is done at fair value plus transaction cost. So if there is a transaction cost, EIR will not be equal to market rate of interest, means EIR you need to recalculate. But if there is no transaction cost, the initial recognition done at fair value only, then can I say EIR will be equal to what? Market rate of interest. This discussion we have done. Same discussion we have done in financial liability also. Correct? I think no changes there now. What is the doubt? Have you understood now? Correct. The next topic is reclassification of financial asset. The reclassification of financial asset, no question has been given in ICAI study mate. Whatever question they have given, that is only to understand the topic. But no full-fledged question has been given. Do you want me to take this concept? Let me take reclassification of financial asset. Now, whenever we say reclassification of financial asset, so financial asset which are debt instrument, that only can be reclassified. Means that instrument can be AC, it can be FBTOCI, or it can be what? FBTPL. Now AC may become FBTOCI or FBTPL or vice versa. This is known as reclassification. Can I say business model changes, so reclassification is required, but reclassification of equity instrument is not permissible. Derivative instrument will be always FBTPL. So only reclassification of debt instrument is permissible. Correct. Now there can be three types of reclassification. Reclassification of AC to FBTPL, FBTOCI. Now whenever we do reclassification, there are 3 points. What will be the reclassification done at what value? Second, reclassification gain or loss will be transferred to what? Third, what will be the impact on EIR? Correct. When I am saying reclassification of AC to FBTPL or FBTOCI, reclassification done at fair value on reclassification date. At fair value on reclassification date. Chalega? Any gain or loss will be transferred to PL and OCI. Why PL? Because this is FBTPL. Why OCI? Because this is OCI. Can you say when it is FBTPL, the question of EIR will not arise, so not applicable. But when it is FBTOCI, so we need to calculate EIR. But in this case, whatever EIR we have taken for AC, that EIR will prevail. Means no adjustment is required for EIR if AC become FBTOCI. So no adjustment due to reclassification, it means use original EIR. Understood this point? Have you understood? Correct. When reclassification is done from FBTPL to AC and FBTOCI. When I am saying FBTPL to AC and FBTOCI, once again reclassification is done at fair value. Reclassification gain or loss will be transferred to PL and PL. PL and PL. Understood? And can you see, whenever AC and FBTOCI we require EIR, but for FBTPL there was no EIR. So in this case we need to calculate EIR. So EIR will be calculated by taking fair value on reclassification date. Means can you see, EIR will be equal to discount rate at which present value of remaining contractual cash inflow will be equal to what? Fair value on which date? Reclassification date. You can apply IRR concept. You can apply IRR concept. Understood? Have you understood this point? Now one doubt will come. Doubt is what? Sir, in previous case you have said PL OCI, but here you are saying PL. One doubt will come now. Have you understood? Just try to understand. Whenever we do reclassification is done on retrospective basis or prospective basis? Prospective basis means, just try to understand. Suppose it was initially FBTPL and this is the reclassification date. Initially it was 10,000 and now it become 12,000. My question to you all, this 2000 gain is of which period? When it was FBTPL, ki when it become FBTOCI? Okay, this gain should be transferred to PL only. Bole yes or no? Correct. Now, when I am saying FBTPL to what? AC. So once again, 10,000, 12,000. So this gain belong to which period? When it was what? FBTP only, it will be transferred to P only. Means doubt is not in this. This is correct. This is correct now. The doubt will come where? Now doubt will come here. Ki why this? Let me come once again. Suppose it was AC. Everyone. AC. Now it become what? FBTPL. Initially it was 10,000. Now it become 12,000. Gain is equal to 2,000 only this period. But for AC, any gain or loss was transferred to PLOCN? No. Means now whatever gain is accumulating, this is on this date now. Because this gain to we have never transferred to PLOCN because it was AC. AC mein there was no fair value gain or loss. Means can I say this gain related to on the date of reclassification, now it become FBTPL. This will be transferred to what? PL. And if it become FBTOCI, it will transfer to what? OCI. Have you understood? I hope you understood now why it is PLOCI, why it is PL. Got it? Got it? Now, coming to reclassification of FBTOCI, same thing. Measurement at fair value on reclassification date. Measurement at what? Fair value on reclassification date. Gain or loss now OCI. Understood why OCI? Because it was OCI. Correct. Can you say FBTOCI? So of course, if FBTOCI become AC, so same EIR will be used. So no adjustment due to reclassification. It means original EIR. But when FBTOCI become FBTPL, no EIR is required. But just try to understand, when FBTOCI become AC or PL, so there is some cumulative gain or loss in OCI. That cumulative gain or loss will be transferred to PL if it become FBTPL. Bole yes or no? So once it become FBTPL, can I say entirely recycled from equity to PL as reclassification adjustment? Means whatever cumulative gain or loss will be recycled to PL if it become FBTPL. But if it become AC, so can you see it should not be recycled to PL? Because for AC, there is no OCI gain or loss. There is no fair value gain or loss. So it will be adjusted with fair value of that asset on reclassification date. Means remove from equity but adjusted against fair value on reclassification date. Means it will be adjusted with the asset only. Because for AC, so there is no fair value gain or loss now. So whatever fair value gain or loss which has been accumulated to separate company equity will be adjusted with financial asset only. Understood? But there is no question based on this. I don't know whether they will ask this type of questions or not. Correct? Understood? So I have just done this. If suppose asked, you should be able to do it. Understood? Chalega. With this we completed what? Topic number 3. Topic number 3 completed. How many topics are there in this? 8 topics are there. So only 3 topics we have done from the morning. Can we come to topic number 4? Topic number 4 is very easy. Because already we have understood financial liability in compound financial instrument. So question already we have taken. So topic number 4 will be very easy, about recognition and measurement of financial liability. Now what India says that for recognition and measurement of financial liability are of 2 classification. One is what? FBTPL. One is what? Amortized cost. One is FBTPL. One is what? Amortized cost. Yes, normally financial liability represent contractual cash outflow. Yes, normally financial liability will represent contractual cash outflow. So whenever there is a contractual cash outflow, it will be always at amortized cost. But if financial liability are held for the purpose of trading, it will be what? FBTPL. Means I have given an example, debenture held for the purpose of buyback. So it means it is held for the purpose of trading, then will not apply amortized cost, then will apply FBTPL. Any gain or loss will be transferred to what? PL. Correct. Understood? And one more point, once again, Ind AS has given an option to the entity that you can designate any financial liability as FBTPL as per your choice. An option has been given. But if that option is selected, this is irrevocable options. Means can I say, if I say, so there are 2 type of classification. One is amortized cost and one is what? Held for the purpose of trading or designated as FBTPL, but both are same now. Held for the purpose of trading or designated as FBTPL as per the option given, both are same FBTPL only. Means there are 2 category, AC and FBTPL. But initial recognition will be done at what? For AC, it will be fair value minus transaction cost. Fair value minus transaction cost. For FBTPL, it will be at fair value. Transaction cost will be charged to PL as an expense immediately. On balance sheet date, case will apply amortized cost by applying EIR. And for FBTPL, it will be at fair value. Fair value gain or loss will be transferred to PL. Correct? That is only given, you can see. Interest will be recognized by applying EIR for amortized cost. In this chapter, means for this topic also they will ask only amortized cost. They will give you all the information. Can I say you can do by your own? You can do it by your own now. Financial liability. But normally for financial liability they ask compound financial instrument. Because if they are asking compound financial instrument, so they are asking both equity and financial liability. And financial liability will be measured at amortized cost. Already I have taken one question there. In this question also, can I say market rate of interest and EIR will be maybe different if there is a transaction cost. Same concept is applicable. So can I assume that this topic is automatically covered? But there is one good news that reclassification of financial liability is not permissible. Means reclassification of financial asset, debt instrument is permissible. But reclassification of financial liability is not permissible. Means reclassification point to completed only. Topic number 4 completed. Understood. Now can we come to topic number 5? Understood. Correct. This much. Topic number 5. What is topic number 5? T recognition. De-recognition of financial asset and financial liability. From my point of view, in this de-recognition of financial liability is more important than de-recognition of financial asset. Means for recognition financial asset is more important, but de-recognition financial liability is more important from examination point of view. Correct? So we'll give more focus to what? De-recognition of financial liability. Got it? Yes, sir. First, let us take de-recognition of financial asset, because of course we need to cover it. Now, when I am saying de-recognition of financial asset, so can you say any financial asset de-recognized when any of the four conditions are satisfied. So what India says that financial asset de-recognized when contractual right to receive cash has been expired. Means if it is hold to collect contractual cash inflow and that is expired, means we receive entire amount, it is automatically de-recognized. Correct? Second, entity has transferred contractual right to receive cash flow from financial asset. Entity has transferred their right to other party. Means if I have a debtor and I said now you pay to this party, so I have transferred that right to you, so automatically debtor should be de-recognized from my balance sheet. But with this, what they said, also transfer substantially all the risk and reward of ownership of such financial asset. Just try to understand. Suppose I say to my debtor, please pay to this party, but in case of bad debt, I will bear. It means risk and reward is not transferred. If risk and reward is not transferred, will you de-recognize? No. Means it will de-recognize only when risk and reward is also transferred that party. Means in case of bad debt, he will bear or she will bear the loss of bad debt. Understood? Correct. Third case, entity retain the contractual right to receive cash flow but assume contractual obligation to pay cash flow from such asset. Means what happens? Suppose there may be one contract, I have a debtor and I need to pay to this party. So what I will say? I will collect the amount from my debtor, but once the amount collected, there is an obligation to pay to this party. Means we have done one arrangement. Correct now. This party said that you don't transfer, you retain the collection right with you. But once you retain, you need to pay the entire amount to this party. Means I have retained the contractual right to receive cash flow. But once the amount collected, there is a contractual obligation to pay to this party, and the risk and reward is also transferred to this party. Means if the amount is not collected, whose loss? This party loss. It means the asset need to be de-recognized. Understood? Are you able to understand? Correct? The last point, entity has not retained control of that financial asset. Means there is no control retained. Means suppose it might be investment in equity shares also. So can I say investment in equity share, there is no contractual cash flow. But can I say if I transfer the control of that investment to other party, automatically it will be de-recognized. So if I don't retain the control of such financial asset, control means what? Now can I say means I have no, if I have transferred the control, means now all the risk and reward is transferred now automatically. Correct? So the entity has not retained the control of the transferred asset, it will be automatically de-recognized. Understood this all points? Correct. Now coming to the accounting treatment. Accounting treatment depends upon whether it is a complete de-recognition or partial de-recognition. Complete de-recognition means what? Entire component is transferred. Partial de-recognition means what? Some component is transferred, some component is retained. Correct? It can be complete de-recognition, it can be partial de-recognition. Correct? So in case of complete de-recognition, very easy. Can I say entire asset will be de-recognized? General entry will be bank account debit to financial asset. Any difference will be gain or loss, which will be transferred to PL or OCI as the case may be. It can be PL or OCI as the case may be. AC, it means if it is FBT OCI, if it is FBT PL, depends upon that. Are you getting what I am saying? Yes, sir. This point you understood? Can you say if you have transferred financial asset and that financial asset is FBT OCI, So the cumulative gain or loss need to be also transferred. So what they said, any cumulative gain or loss that has been recognized directly in an equity will be reclassified to PL if it is debt instrument, will be transferred retained earning if it is equity instrument. Already we have done initially only. Have you understood this point? Means any cumulative gain or loss need to be recycled if that financial asset is FBTOCI debt instrument. It will be transferred retained earning if that financial asset is what? FBTOCI equity instrument. Got it? Understood? Correct? Yes, sir. Now for partial derecognition, this is one important topic, partial derecognition. Partial derecognition. Partial derecognition means some component has been transferred, some component is retained. Means either principal component transferred, interest component retained, or interest component transferred, principal component retained, or some portion of principal transferred, some portion of interest retained, some portion of both is what? Transfer retained. Quite possible. In that case, what will do? In that case, what will do? Correct now. I can take one example regarding this. Let us take one example. Correct. Suppose we have one financial asset, a loan, whose carrying amount is 10 lakh. Correct? Understood? Contractual rate of interest is 10%. And let us assume market rate of interest is also 10%. Means not market. ER is also equal to 10%. When I am saying contractual rate of interest and ER is equal to 10%, means this is at market terms and there is no transaction cost. Chalega. I can give you also what? Different EIR. But it will not make any difference. Understood? And this is what? Remaining 4 years. How many years? 4 years. Now, this loan was transferred to P Limited. But transferred what? 40% principal amount transferred and 70% interest amount transferred. Understood? Expected yield rate means current market rate of interest is equal to 12%. Quite possible. My question to you all, if you are transferring the asset right now, you will transfer, means if you are transferring the asset right now, it will be transferred at current fair value. Current fair value will be calculated at current market rate of interest. Understood what I am saying? Means this loan was taken, this loan was given, suppose 5 years before, and this is the remaining life. So now, can you say first you need to calculate fair value of loan on the date of derecognition? How to calculate? You will give me. What is step number 1 in this? First calculate fair value of loan. So fair value loan means what? There are two components, principal component and interest component. The principal component is how much? Nothing is given, it is redeemable at par only. It is amount is 10 lakh, so that will be only received. So 10 lakh. Can you say it will be multiplied by what? Present value factor at a rate of 12% for 4 years. Can you give me what is the amount? How much? How much? 0 point? Six three double five. It is coming how much? 6 lakh 500. ठीक है ना? Then interest component is 1 lakh into present value annuity factor at a rate of 12%, 4 year, how much? How much? 3.037. It is annuity factor 3.037. This is coming how much? So can you see you have calculated fair value loan. The total fair value loan become these two amount. Correct. Now step number 2, what you will do? What they said? Allocation of carrying amount. So what they said? First find out portion transferred. So can you say how much principal portion transferred? As per my question, 40%. And how much interest portion transferred? 70%. Then find out portion retained. How much principal portion, how much interest portion? Are you able to understand? Now we know fair value. So fair value of principal portion 40%, can you give me? It is 6 lakh into what percent? 40% how much? 2 lakh. And how much 60%? 3 lakh 81 300. Similarly, what is the fair value of interest component? 3 lakh 3,735 into 70% how much? And how much 30%? 91 120. Can you give me the total of all this? You can give me this total also. Then all 466 466 and the total give me total of these three, means these three total. 9,39,235. Now what is the carrying amount? Carrying amount is 10 lakh. So what India says that this 10 lakh will be allocated in this ratio. So the 10 lakh carrying amount will be allocated in the ratio of fair value of portion transferred and portion retained. So can you allocate in this ratio? This, can you give me this amount, and this amount? Four lakh 97. Then 97,015. Understood? What will be journal entry? For the portion transferred, journal entry is what is the fair value of consideration received? So how much you have received? This much amount you have received. Fair value you have received. Correct now. So bank account debit how much? 4,66,000. And how much de-recognize? How much loan de-recognize? 4,97,016. How much difference? Difference will be loss. Loss how much? 31,000. Are you able to understand what I am doing? And for the portion retained, what journal entry? What they said? To recognize principal portion, principal, we call it principal strip account debit, and interest strip account debit to loan account. And this will recognize that they are carrying amount only. Means on this there is no gain or loss. This amount and this amount. So how much is 4,05,968 and 97,015. Total of this 9,983. Understood? Normally in exam, student do mistake in this amount. They will take fair value. But the portion retained will be recognized that they are carrying amount only because there is no gain or loss on portion retained. Have you understood this journal entry? Have you understood? Bolo. Correct? Yes sir. That is only given. Check करेंगे. For partial derecognition, when a portion of contractual right to receive cash flow is transferred, step number 1, calculate fair value. Calculate what? Fair value of transferred and retained portion by applying expected yield rate of transferee. If fair value is not given the question, sometimes fair value might be given the question only. Thank you very much. If not given, we will calculate present value by applying what? Expected yield rate of transferee. Means what is the expectation of transferee? That is nothing but current fair value, current market rate of interest, current market rate of interest adjusted with some risk factor. Risk factor means there may be some chances of bad debt, etc. So there may be some credit risk. So that market rate of interest may be adjusted with what? Some risk factor. That become expected yield rate of transferee. So that expected yield rate will be given in the question only. Are you getting? Then you will allocate the carrying amount. You will allocate the carrying amount of financial asset in the ratio of that fair value. That only give. Then accounting treatment for transferred portion, bank account debit to financial asset. Any gain or loss will be transferred to either PL or OCI as the case may be. Then for retained portion, you can see what journal entry I have given: principal strip account debit, interest strip account debit, servicing asset account debit to financial asset. Servicing asset means what? Is sometime the transferor become collector. I say now we can collect on behalf of other party. So whenever we collect on behalf of other party, so we will charge some fees for that. That is known as collection fee. So that collection fee, for that collecting the amount, we receive some amount from that party, or we may retain some portion of interest. So whatever amount we have retained for collecting the amount, that is known as servicing asset. So that will be also recognized separately. Are you getting? Servicing asset account debit to financial asset. But this will be at what? Allocated carrying amount. Got it? Correct. Now whenever partial derecognition, so once again there can be some cumulative gain or loss. So what they are saying, that cumulative gain or loss will be also allocated to transferred portion and retained portion in the ratio of their carrying amount. Sorry, in the ratio of their fair value. That cumulative gain or loss means if it is FBTOCI, so there will be some cumulative gain or loss. So that cumulative gain or loss will be also allocated to transfer and retained portion in the ratio of their fair value, and cumulative gain or loss allocated to transferred portion will be either recycled to PL or transfer retained earning as the case may be. Got it? But this type of question they have not given in ICAI study material. Have you understood this point? Follow. Any doubt? Are you getting what I'm saying? Have you understood? Correct. We'll take 5-minute break and then we'll continue the derecognition of financial liability.